Okay, we're going to get started now. Good morning again. My name is Adam Goldstein from the Federal Home Loan Bank of New York, and we welcome you to today's webinar. Today, our financial economist, Brian Jones, will discuss the road ahead for the national and local economies in 2021 and beyond. If you find today's webinar valuable and would like Brian to speak to your leadership team or your board of directors, just let your relationship manager know. We'll be happy to set up a private session. Brian has done several of these sessions with our members, and the feedback has always been great, so he's at your disposal anytime you'd like to use him. You're welcome to. As a reminder that this session will be our last webinar for now. As we did last year, we took a break over the summer, reevaluated our content strategy, listened to you, did some surveying, and come up with the best educational programs that we can for our members, whatever the topical issues are. You can also access previous sessions that are recorded in our financial intelligence library on our website. So please look out for that. And if you can't find it, just reach out to your relationship manager. We'll help you get to the right place. A couple highlights before we get started. Just a reminder that our advance special will be ending Wednesday, June 30th next week. To take advantage of adding symmetrical prepayment advance features at no additional charge. So we'd encourage you to take a look at that, and obviously happy to talk to you if you have any interest in that. Also on May 3rd, our 2021 Homebuyer Dream program opened with $16.3 million in available grants made for supporting homeownership opportunities. The round will remain open to participating members through November 30th. So this is a program that offers grants for up to $10,000 with up to $9,500 for down payment and closing cost assistance to eligible first-time home buyers purchasing a home through one of our approved community-based member lenders, and an additional $500 towards the defrayment of home ownership counseling. Also, we want to remind you, if you are not reading our MSD Weekly, we'd encourage you to take a look at it. We created that document to provide insights into current market trends and news, and it's released every Monday. Our member service desk writes some portions of that, as well as Brian Jones, our economist, has a piece in there. So if you're not receiving that, just give us a holler, and we'll be sure to put you on the distribution list. Finally, we continue to onboard our members on our mortgage asset program. That program has converted most of the members that were selling loans to the Federal Home Loan Bank of New York through the MPF program, which sunsetted earlier this year. So if you have any interest in that, given what's happening in the economy right now in the markets, we'd be happy to talk to you about that program. So just let your relationship manager know, and we'll be happy to set up a one-on-one session just for your team. Okay, so quick details for today's webinar. If you have any questions, please submit them at any time through the question box, and they'll be answered at the end of the session. We do ask you to complete the survey, even though we're taking a break for this summer. We do want to know what content is meaningful to you, and we'll do our best to serve you and create that educational content for whatever's meaningful. Now I'd like to hand it off to my friend Tom Citino, Vice President, Director of Member Relations, who will introduce the webinar. Tom, take it away.
Thank you, Adam. Good morning, everyone. I appreciate everyone joining us for this session. It should be a good one. Many of you have already heard Brian Jones speak in the past, but he's our financial economist here at the Home Loan Bank of New York. He's been with us approximately 3 years, and he provides macroeconomic analysis and also microeconomic analysis of our district, which helps us gain strategic insights and which are utilized throughout our organization. But Brian's been an economist for over 3 decades. He's worked at a variety of leading domestic and foreign financial institutions, including Societe Generale, Citibank, Solomon Smith Barney, Solomon Brothers, Lloyds Bank, and Irving Trust Company. And throughout his career, he supported all aspects of the fixed income, currencies, and commodities businesses with regard to U.S. Macroeconomic analysis and forecasting. So with that, I hope you all enjoyed this session. And with that, I'll turn it over to Brian. So Brian, take it away.
Good morning, everybody. Let's dive right into the presentation. Okay, what we've gone through recently with the pandemic is something we've never experienced before in our economic history, where we actually had a contraction in business activity. It wasn't generated by the normal factors. It was something out of the ordinary. Typically, when we've had recessions over the last century and change, It's been attributable to industrial items. For example, there's always cutbacks in production after we end major wars, oil price shocks, monetary policy shocks. The longest tend to be those associated with financial crises, such as the Great Depression or the Great Financial Crisis of 08-09. Sometimes fiscal contractions have caused business cycle downturns. But this is a first, a healthcare generated economic downturn. The fortunate thing here is that even though we have all been sheltering in place for over a year now, is that, to be fair, the length of the recession was actually quite short. Typically, the length of an average recession in the United States is a little over a year. The latest one was just about 2 months in time, spanning March and April of last year. It looks like right now where we are that economic activity has, not only has it been expanding on a GDP basis since last summer, but it looks like the quarter that we're in right now that we've had a pretty steep acceleration in activity. We got the government's final estimate of Q1 this morning at 6.4%. But right now, tracking estimates for GDP in the second quarter are averaging around 9%. But as you can see here, the estimates vary widely from a low from the New York Fed at a little bit below 4% to as high as 11% for one of the large domestic investment banks. But again, pretty much universally, with rare exceptions, people are looking for a very sharp activity over the April to June span. What are we looking for beyond that? Well, it looks like we're entering a period of above trend growth for at least the next 2 years. Trend growth in the United States is generally pegged at about 1.8%. Basically, you get 0.8 for population growth, 1% for productivity growth. That's how they come up with the 1.8%. But as you can see in this chart here, even though we do have a gradual slowdown beyond the spring, the growth rates over the next through the end of 2022 are actually going to be quite steamy and still above trend. Where does that leave us? Well, in the current quarter, we should get back all of the lost output to the pandemic. So we will have recovered fully all of the lost GDP in the second quarter of this year. And it looks like, given the consensus projections that we have in hand, that we'll be back on the long-term trend line probably sometime in the fall of this year. And we'll be moving pretty much at a trend-like pace on this long-term trend line beyond that period of time. As far as recessions are concerned, as I said before, the downturn that we experienced was actually quite severe. It was undoubtedly quite severe, but it was also extremely short. The folks at the St. Louis Federal Reserve Bank, they've come up with a recession probabilities gauge that tries to mimic the thinking of the National Bureau of Economic Research, which are the people that basically determine business cycle turning points. And their recession probability gauge, as you can see in this chart, it rose sharply in March and April of last year. But once we got beyond April, the probability that the economy remained in recession actually moved below 1%. And where we are in April of this year, we're still shy of 1%. So to be fair, the economic expansion, my guess is that when the NBER gets together, they're going to basically put the trough of the downturn at April. And basically, we're in the midst of an expansion that's over a year in length. As far as the probability over a recession over the next 12 months, the New York Federal Reserve Bank has constructed a recession probability gauge that's based on the slope between the yield curve between 10-year notes and 3-month bills on a bond equivalent basis. And their latest estimate, which is for May, we'll get one in the first week of July for June. The probability of we'll be in a recession almost roughly 12 months from now, they put it at about 6%, which is quite low. So right now, we're in the midst of an economic expansion, and at least as far as financial variables, as evidenced by the yield curve are concerned, it doesn't look like there's much of a probability that we'll be in a recession over the next year. As far as recent economic data, the data continues to come in better than expected. Basically, what's important in gauging what overall activity is going to do is whether or not the numbers are coming in better than expected vis-a-vis economist expectations. Now, clearly, the gap between the reported numbers and expectations is closed. I mean, as economists, I mean, to put it simply, we get better as time goes on. If we're missing in one direction, guess what? We'll start moving our forecast in that direction, and we'll ultimately close the gap between what's observed and what's expected. And that's essentially where we are right now. I mean, there was a sharp overshoot as we came out of the worst of the pandemic in the spring of last year. And right now we've settled in where we're still getting better than expected readings vis-a-vis what are pretty much economists' rosy expectations. If we look at key variables of the economy since the pandemic, since before and after the pandemic, essentially all variables that are not related to the labor market are actually well above levels that were reported in February of 2020 as the pandemic began. Whether we look at core retail sales, we look at capital equipment spending, building permits, the ISM gauges, they're all above where we were. So we've more than made up the losses in those variables as a result of the healthcare crisis. Again, the lagging variables are those that are associated with the labor market, whether it's non-farm payrolls, total hours worked, or industrial production, which relies heavily on labor inputs. What's essentially going on here is that, to be fair, as we've been able to negotiate this thing successfully in a remote posture, most of us, there's a lot of activity that's just not being done and won't be done until we reopen. And that will get better as we go through time, as more and more Americans are vaccinated and we approach almost full vaccinations. As you can see in these numbers here, we've made a tremendous amount of progress on the vaccine front. And in fact, these are probably the most important areas. As of the latest data that we have in hand, over half the country has gotten the first dose. Those that are fully vaccinated were about 45% change. The encouraging thing here is that the performance within our own district has actually exceeded national averages. For the most part, with the exception of the Virgin Islands, within the Federal Reserve Bank of New York district, which includes New York, New Jersey, Puerto Rico, and the Virgin Islands, with the exception of the Virgin Islands, all areas are reporting that their populations have received, over half their populations have gotten the first dose of the COVID-19 antidote. And if you look at those that are fully vaccinated, pretty much across the area, we're getting very close to half. So we're making a tremendous amount of progress on that front. And that is starting to show up in office occupancy numbers. People are returning to their work sites. We are lagging. New York, the number of people, percentage of people that have returned to office in the New York metro area, as the latest data that we have in hand, is about 22%, which is about 10 percentage points below the national average. Part of that, the big part of that is because of the concentration or the distribution of where jobs are in our district, in our area's economy. We have so much activity that's concentrated in service-producing areas where there's a high degree of social contact that's involved. And until more and more people get vaccinated and we fully remove all these restrictions and get back to work, we are going to lag the rest of the country. And there's not much that we can do about that. But again, the numbers are doing fairly well over the last 6 weeks nationwide. We've gone up by almost 5 percentage points. And to be fair, in New York, again, we were 5 weeks ago we were about 16%. Now we're at about 22%. So we're doing well. We're doing better as well. And the other encouraging thing is that we are no longer the major metro area with the lowest occupancy rate. So we've gotten off the floor. As far as recent developments in the labor market, hiring did pick up in May. We created almost 560,000 jobs. Of course, those were concentrated in the service-producing areas that were hardest hit by the pandemic: education and health, leisure and hospitality. There'll be further gains in the months ahead. And if you look across all of private industries, we've gotten back about 70% of the jobs that were lost as a result of the healthcare crisis. And that's set to improve even further as we reopen segments of the economy, especially our own. As far as unemployment measures, they do remain elevated. We've had a lot of progress on both the unemployment rate, the typical unemployment rate, which is known as the U3. We're a little bit below 6%, probably headed to about 5.5%. in the current month, and on what the extended unemployment rate as well, which includes those marginally attached to the labor force and those working part-time for economic reasons. But again, we still have to make further progress here to get back to what most economists would put as full employment, which is about a little bit north of 4%. As of this morning, as much as we have had some improvement in the unemployment statistics, we need to realize that as of the latest data available, we still have a little over 9% of our population that is receiving some sort of unemployment assistance through a variety of programs. We have to be careful when we look at the weekly jobless claims report, for example, because those numbers are just people that are either filing or collecting under regular state insurance programs. Because of the healthcare crisis, we have a lot of people that are collecting unemployment benefits through a variety of pandemic-related programs, and we really need to incorporate those to get a handle on what the total number of recipients are. And right now, they're running a little bit shy of 15 million people. So we still have a lot of people that need help and need to find positions in coming months. Turning to the inflation numbers, which have gotten a lot of attention recently, whether it's been in the market or it's been amongst Federal Reserve policymakers, we have had a sharp increase in core consumer prices, excluding food and energy, on a year-over-year basis. And this is going to be baked in the cake for a while just because of the way we do year-over-year calculations. There were, I'd say, 4 items that really have driven prices higher over the past several months. The first is a return to normality in airline fares. As more and more Americans get vaccinated, healthcare restrictions are removed, and people start traveling again, airline fares have started to, well, at least attempt to get back to where they were before the pandemic struck. Another area has been the automotive sector. Because of shortages of chips, the availability of new vehicles has been kind of limited. And as a result, not only have new vehicle prices gone sharply higher, but used car and truck prices have jumped sharply as well. There is some encouraging news on that front. There is data available on the used car segment from a research firm called Manheim, and their numbers for June that just came out show that at least used car prices have stabilized. They're no longer headed higher at the massive rate that they were going over the last 3 months, and that should filter into the next CPI report. The other areas where we've had pickups in prices, one that stands out is automobile insurance. Many of us were granted rebates and over the course of the pandemic because the insurers realized that we weren't driving, we weren't going anywhere. So a lot of people got haircuts on their monthly auto insurance payments, and that has been reversed. As people have returned to the road, the automobile insurers have started to try to return their rates to where they were before the pandemic struck. But this is likely going to go on for a while. We're going to have inflation readings on a core basis above the Fed's 2% target, certainly through this year and probably into early next year as well. One of the most encouraging things, and the Fed does point this out when they may issue their statements following the FOMC meetings, is that financial conditions in the economy, measured by money market and bond market spreads, bond and equity market volatility, equity prices, financial conditions have gotten significantly easier over just the last 5 weeks. In fact, where we are right now, financial conditions in the U.S. are at their most stimulative level, or accommodative level, in almost 3 decades. You have to go all the way back to 1992 to find an environment where you didn't have as much tailwinds helping you from the financial sector. Where we are now on interest rates, well, over the last 5 weeks, we've had a dramatic flattening of the yield curve. Even though people are allegedly more concerned about developments on the inflation front, we've actually seen the spread between 2-year notes and 10-year notes narrow by almost a quarter percentage point, and the gap between the 30-year bond and 2-year notes by 32 basis points. So we've had a fairly dramatic flattening of the curve over the past 5 weeks. Now, going out further, interest rate forecast did move higher, basically following market interest rates last month. The current forecast that we have in hand for the consensus is the consensus basically sees higher rates and a steeper curve through next summer. Basically, the steepness is largely attributable to the fact that people expect the Fed to remain on hold for an extended period of time, which anchors the short end of the Treasury yield curve. And the higher rates of, going from 2-year notes out are basically attributable to the fact that you're going to have faster growth and potentially higher inflation. Looking at where policymakers see the world, we did get updated forecasts out of the Federal Reserve at the end of the June meeting. The Fed now sees real GDP growth on a year-over-year basis, on a calendar year basis, along with 7% this year. And that's probably a little bit conservative. I think if you look at the consensus of private sector forecasts, it's probably closer to 7.5% to 8%. But even next year, the Fed's got us slowing to 3.3%. Now, you can focus on the slowdown, but what I think you need to look at is the fact that you're still almost double the long-run growth rate, which they peg at 1.8%. As far as unemployment is expected to fall substantially over the balance of this year. We're at 5.8% now. My guess is we could get to 5.5% in June alone. So we just need another percentage point to hit the Fed's target of 4.5% by the end of this year. Next year, the policymakers see the unemployment rate moving to 3.8%, and in 2023, ending the fourth quarter at 3.5%. The important thing here to observe is that if we just assume that full employment is 4%, the Fed's essentially telling us that they expect the U.S. economy to be back at full employment sometime next year, and to get a significant overshoot. I think what the Fed is trying for here, and again, whether or not monetary policy is the best way to achieve this is an open question, is the Fed is trying to get a more inclusive recovery. And by that, not only faster growth, but they want to see the unemployment rates for segments of the population, Black Americans, Hispanic Americans, Asian Americans, return to the all-time lows that we were experiencing before the pandemic struck. So in some sense, the Fed is going to let things run hotter on a GDP and an unemployment rate basis than they might have in the past. Turning to the inflation forecast, again, the Fed does think that this inflation flare-up that we've seen is going to be temporary. That we're going to see a year-over-year growth rate and overall inflation of about 3.4% this year and 3% on a core basis, but returning closer to the target of 2% by next year. Now, where are we on as far as policymakers see developments on the interest rate front? With the last meeting and the summary of economic projections that came out, more Fed policymakers now do think that we could possibly see increases in the federal funds rate by the end of 2023. Essentially, what the median dot in this plot calls for in 2023 is that we get two 25 basis point hikes over the course of 2023. The thing that I think we need to bear in mind here is that there's a fair chance that the tightening, or at least the tightening is represented by with the so-called dot plot here, is that it could very easily move into 2021. In fact, all we need is two policymakers to become marginally more hawkish to pull the first tightening a full year forward into calendar 2022. So I think we should bear that in mind when we get to the September meeting and we get an updated dot plot. As far as the long-term federal funds rate, no change in that. Policymakers still think that over the long run, the nominal federal funds rate should average around 2.5%. Looking at the other item of monetary policy, and that's Federal Reserve holdings of securities, they've almost doubled over the course of the pandemic. We've had a $3.6 trillion increase in securities held outright by the Federal Reserve. Now, there's a lot of talk of tapering. the asset purchase program that the Fed has in place right now. But as much as they have discussing it in the press, I don't think they've had they've formally have sat down to give this thing a lot of thought. Having said that, I think they will over the course of this year. I think given the pace of growth, given what prices are going to do, that they're probably going to take it up very seriously by the September meeting. There may not be an announcement of any formal tapering until the December meeting. That would be essentially the same behavior that they exhibited in 2013 when they started. And if they do make an announcement in December, they will probably start pulling back from the asset purchase program at the beginning of next year. Turning to the other side of the policy, the policy coin, we've got to prepare ourselves for larger federal deficits for the foreseeable future. And obviously, we've got larger deficits because of the enactment of the American Rescue Plan Act. You can see in the left-hand side panel here with the American Rescue Plan having passed it, the interim deficits are going to be substantially greater than originally projected. The other thing that we'll need to bear in mind is that there may be more stimulus if they can get together in Congress and the administration and come up with a longer-term infrastructure program. And that certainly would add to the deficit over the foreseeable horizon. Against that backdrop, what's going to happen is that if you're going to run larger and larger deficits at a time, you have to find a way to pay for those. You're going to have to fund those through greater issuance in the Treasury market. And over the course of the next 10 years, we're probably going to see a dramatic pickup in not only the overall size of the debt held by the public, but also as a percent of nominal GDP. And at least the latest data that the CBO has come out with says that we could be the percent of nominal GDP, the debt held by the public as a percent of nominal GDP will be a little bit north of 100, a little bit shy of 100, a little bit north of 107%. By the year 2031. Turning to something that's closer to our wheelhouse, looking at the residential real estate market. Basically, we've had interest rates come down lower in the mortgage market, especially longer-term fixed-rate mortgages, 15 and 30-year fixed-rate loans. That's essentially mimicked what we've seen in the Treasury market. The problem is that we have had some response on refis, but we haven't had much response on home purchase applications. And essentially what's going on there is that even though rates may be attractive, the fact of the matter is, and we'll go through this in a little bit more detail quickly, is that there's very little available stock on the market right now. And this is not just a countrywide problem, it's especially severe across the New York and New Jersey areas, the number of homes available for sale. Turning to that, you can see right now that if you look at the left-hand side panel here, that essentially existing home sales are where pending home sales would project them to be. Pending home sales are contract signings. Existing home sales are closings. So there's about a 1 to 2 month lag between a contract being signed and it ultimately being closed. But right now, nationwide, we're essentially where these things have caught up. There is a lag, though, in the local numbers. We did get a pullback in closed sales in New York and New Jersey in the month of May. We didn't get much of a pullback in pending sales or contract signings. So my guess is that maybe the time period involved in going from a contract signing to closing is still a little bit extended in our area, and we probably still have some ways to go on closed home sales in New York and New Jersey in the next few months. As far as what's going on in our area, looking more closely at the real estate market in New York and New Jersey, as you can see in the left-hand side panel here, we continue to see reductions in the number of homes available for sale across the two states. And even if we look at more granular data by county across New York and New Jersey, you'll see that available homes, with few exceptions, are double-digit below where they were in May of last year across the area. And that is one of the major factors driving median prices. substantially higher across New York and New Jersey. And you can see that in the right-hand side panel here. Pretty much things bottomed out either very close to or a little after the pandemic, the worst of the pandemic in April of last year. And we've been steadily headed higher to historic levels on median selling prices across the two states over the last several months. Given the fact that prices have moved higher, needless to say, affordability has contracted sharply across the two states. Affordability is significantly lower in New York than it is in New Jersey, and you can see that in the left-hand side panel here. And now I think that turning to the chart here on the right-hand side panel, I think I'm going to have to change my vertical axis, because with the data that just came out over the last 2 days for New York and New Jersey, across the two states, on average, sellers are receiving more than their asking price. New Jersey, you're almost at 102% of asking price, and in New York, you're above 100%. So this is clearly a seller's market across the two states, at least in the aggregate. Looking at the month supply numbers, basically the month supply numbers have started to tick off their lows, but it's really more a function of sales having come in rather than inventories going up. So you got to be a little bit careful when you look at those numbers. And to show you how steamy the market is in our area, you can see the number of days that homes are remaining on the market. Across the two states, we're a little bit shy of 50 days on the market. And with the numbers that came out this morning for New Jersey, we're actually through 40. So I'm going to have to change the axis there. But homes are changing hands very quickly. I mean, you can find areas, I think in the national report that came out, the National Association of Realtors report, nationwide, homes were changing hands in 17 days. So just a little over 2 weeks' time. There has been a response from builders to the lack of available homes, but the problem is that it takes a lot of time. You can see that these are building permits in New York and New Jersey, both single-family and multi-family, and you can see that for the most part, since the Great Financial Crisis of 08-09, the single-family permits essentially, I mean, there's a small uptrend there, but I mean, you need an electron microscope to kind of find it. But recently, as we've moved through the course of the healthcare crisis, builders have responded to the lack of homes on the market. And now, at least single-family building permits are approaching levels that we last saw before the financial crisis. So there are encouraging things there. The thing that continues to constrain us is a lack of available lots, building regulations, higher materials and labor prices. But again, at least they are moving in the right direction. It seems that the multifamily stuff, after a bounce out in the middle of last year, it looks like we've essentially been moving sideways since then. As far as the mortgage market, delinquencies continue to move lower, both nationwide and in our area, although in New York and New Jersey, statistics remain elevated relative to the rest of the nation. We have some of the highest delinquency rates across the 50 states. The other encouraging sign is that the percent of loans that are in forbearance continue to move lower. As of the latest data out there, about 3.9% of mortgages were in forbearance. That's a big improvement from the pandemic peak, which was about 8.6%. We also have seen a more than halving of the number of loans that are in forbearance. Right now, we're at about 2 million. At the peak, we were at about 4.3 million. Turning to commercial real estate and non-residential construction, at least nationwide, things look like they're picking up a considerable amount of steam. To get an idea of what's going on in the non-residential building area, I like to look at this the Dodge Momentum Index, which is constructed by Dodge Analytics. Basically, what they're trying to get a handle on are the initial proposals for non-residential building projects. So these are things that the plans have been set. No ground has been broken or no foundations have been laid, but basically the plans are in place. And you can see that as we progress through the healthcare crisis, there's been a sharp increase in the number of institutional building projects that have been planned, and also commercial projects as well. And as of the month of May, there were 21 projects valued at more than $100 million that entered the planning phase in May, and that's almost the double of the average of 11.3 projects per month over the last 2 years. Our area, however, it continues to struggle. And I think when you look at commercial real estate in at least our district, you need to segment it into 3 areas: the office market, the industrial market, and shopping centers. The office market is still going to be under a tremendous amount of pressure in our area in coming months, coming quarters. Basically, because of people leaving their offices, working at home, there's been a lot of empty office space that has come on the market. You can see that in the left-hand side here. Places like in Midtown New York City, for example, you've got about 11.5 million square feet that are empty as of the end of the that have become empty as a result of the pandemic. Midtown South's about 5.5. Against that backdrop, we have seen increases in vacancy rates. And these are changes here on vacancy rates. So, for example, the vacancy rate in Midtown New York and Midtown South has gone up by 5.2 and 8.7% respectively. And you can see against that backdrop, the rents have come down in a variety of areas. There are other areas that have done better: northern New Jersey, upstate New York, Westchester County, as far as rents. Now, when you look at the industrial market, which is warehouses and the like, that's pretty much firm across the whole coverage area of the Federal Home Loan Bank of New York. You can see that there's been positive net absorption since the fourth quarter of 2019 through the first 3 months of this year. Vacancy rates, for the most part, have come down, and asking rents have gone up a lot in a variety of areas. I mean, you've got some areas where asking rents are up almost 50%, like Buffalo, New York. The final area which still remains weak is shopping centers. And shopping centers are suffering the same way the office market is for the same reasons. Turning to the labor market within our district, we continue to grind out new jobs, although it's a tougher sledding for us. As of the month of May, we've created about 1.5 million jobs from May of last year. So right now we've gotten back about 54% of the jobs lost as a result of the pandemic. So we're lagging about 10 percentage points behind the remainder of the nation. And the reason for that is primarily because of where the jobs are concentrated across our district. We've got such a heavy concentration in service-producing areas, and those were the hardest hit by the pandemic. And you can see that in the right-hand side panel here, where things like education, health, leisure, and hospitality have gotten back a little over half of the jobs that were lost. So we still have a ways to go there before we return to normal. As I said before, we're running about 10 percentage points below the remainder of the country. The country's gotten back almost 2/3 of the jobs lost were 54%. But against that backdrop, the labor market performance is all a function of where you are. I mean, for example, New Jersey Puerto Rico has done the best in recovering jobs as far as our district is concerned, followed by New Jersey and then New York. But you can see when you look into the granular data, I mean, for example, in New York City has gotten back just 42% of the jobs lost. So New York, the city's got a long way to go, and hopefully as things open up and we return to work, that those numbers will start heading higher as you start reopening restaurants, theaters, and the like. The flip side is the unemployment rates, which is, I mean, there's two surveys when we look at the monthly employment numbers. We've got the establishment survey that gives us our jobs numbers, and then we've got the household survey that gives us our unemployment rate measures. And as you can see in this chart, I mean, basically this is the same story, just told a different way. Unemployment rates continue to move lower across our district, but universally, we're about 2 percentage points higher than the nation as a whole when you look at unemployment rate figures. Returning to the local economy and what may be in store over the next several months, manufacturing activity in New York State has been expanding for over a year now, and it's expected to continue along that path in the future. In fact, firms' optimism as far as manufacturing activity over the next 12 months, it's at almost historic levels right now. So at least that segment is very optimistic about what's going to happen over the next several months. The one area of the economy, and this is probably the brightest spot because we do have numbers through June, is the service-producing segment in our area. Now, these are numbers out of the Federal Reserve's Business Leaders Survey, which covers not just New York, but also Southern Connecticut, Northern New Jersey. So it's a broader survey, but we've had a sharp improvement in service sector activity in the latest months. We're back to the left-hand side panel. We're well above the 50% reading, which shows that we're essentially activity stable. But what's very encouraging in that chart is that firms' appraisals of the business climate that they're operating under have now moved back to 50%, which essentially says that things are getting back to normal. You can see from the red line in that chart that in the midst, throughout the pandemic, the business climate for these firms has been flat out abysmal. And like the manufacturing sector, if we look at the right-hand side here, firms not only think that there's going to be a sharp pickup in activity in the next 6 months, but they think that the business climate is going to be much better than it's ever been in the past. If you look at that blue line there, which is what firms think the operating environment will be 6 months down the road, we're just off the all-time high in the latest report. And that concludes my presentation. And with that, I'd be happy to answer any questions that you might have.
Hi, Brian. Thanks a lot. It was a great presentation. We do have a few questions. We're running short on time, but we have a couple. So let's start with the first one. This individual had asked about the Federal Reserve's views on inflation. There was some commentary that stated that they believe it's temporary. What are your thoughts with respect to that?
Right now, the data that we have in hand, we don't have a lot of it, but it suggests that they might be right, especially if we look at the automotive market. Because as I said before, it looks like used car prices have stabilized in the month of June. And to be fair, that was the one segment that really accounted for most of the pickup in core inflation over the past several months.
Okay, and another question, Brian. Thank you for that. The time frame for tapering. I know the Fed's been, considering it. So when do you think the Fed's seriously going to consider it and announce it and eventually start it, and to what magnitude?
I think they're going to seriously start considering it once they get the second quarter GDP figures in hand. The September meeting may be a little bit early to actually announce the formal tapering. I think if they approach this the same way they did the tapering in 2014, what will happen is there'll be more and more people hitting the stump saying that they're looking at it seriously. I think they make a formal announcement in December. And that they actually begin the tapering process in the beginning of next year.
Okay, thanks, Brian. And then lastly, final question. I know you had spoken about some of the regional housing statistics, specifically with respect to New York City. I know there was a lot of flight out of New York City, and then property values or apartment values have plummeted, specifically in Manhattan. What are your thoughts about Manhattan residential real estate?
I think it's just going to take some time for Manhattan to come back. And I think there's already some evidence in some neighborhoods that basically, rents did take a real big hit through the worst of the pandemic. But now, as more and more people become vaccinated and we gradually return to normal, Rents are starting to go back up again. I mean, I think you've got to be really careful. I mean, throughout my working life, New York's been written off several times, whether it was in the 70s because of the financial crisis, whether it was in the wake of 9/11. And it's always been, the city always bounces back. So it's always been a desirable place to live, especially for young people. So I never write off New York. It's just a matter of time, I think.
Okay, well, thanks, Brian. A great presentation. Appreciate your time on this. Folks, I just wanted to say that this concludes our webinar series. We'll pick it back up in the fall. So have a great summer. I'm sure we'll be speaking to one another. If you were interested in Brian doing a session with your board, with your boards, or with your management teams, just please reach out to your relationship manager, and we could discuss it and get it on the schedule. So again, thank you, Brian, and thanks everyone for attending, and have a great weekend.